Let's begin today's session. Good evening and greetings to you all from Enrich. Today's session is on the basics of candlestick pattern analysis. Now, many of you might be thinking that you're new to trading and will this session help? Because I have no idea about these things, how these things work. Not to worry, because in this session, I'll walk you through step by step on these patterns, all right from the beginning to the end. And I'm sure by the end of the session, you will be able to understand what these patterns are and why they are important in trading. So basically, we're going to deal with the basics of candlestick pattern, all right? And for those of you who are already experienced and experts in this, you can take it as a revision, right? Okay. So before I start, I would like to acquaint the newcomers, the new joinees with Enrich. Enrich basically started in 2008 as a research unit and got incorporated in the year 2013 and evolved as a complete business unit in the year 2015 and is also a registered member of MCX and NSE. Now, I'm sure many of you have already opened a trading account by now, but if you haven't, not to worry. You can just get into enrichbroking.in, as you can see here, click open an account, and within just 5 minutes, you can open an account all by yourself without anyone's help, okay? All you need to do is fill in the details asked, like your PAN card and your mobile number. Just fill in your PAN card and mobile number and log in. If you have an issue with logging, just request a callback. Another way of finding out how to log in completely is to get into our YouTube channel, Enrich Academy. Just type in Enrich Academy. Here it is. And we have all the details related to trading in this academy, all right? Right from the beginning of basics of trading to the different terminologies of trading. And also we have a video about how to log in to the Enrich Web Hunt application. Yeah, just need to click videos over here, right? I'm sure many of you know this by now, but I'm just repeating this for the sake of the new joinees. So you have all the sessions here, intraday live sessions, candlestick pattern, right? Just go in and click whatever information you would like from here, okay? And if you also go into the Enrich website, you can view the various products over here. It's Web Hunt, Mobile Hunt, Market Hunt, and Nest Trading. Web Hunt and Mobile Hunt are very popular with our customers. You can also click research to find out the commodity reports and equity reports. Every morning by 8:30, you will get the reports. You also have the intraday live tips over here. There's also a wonderful scheme, refer and earn scheme for both clients and franchisees. You just need to click client over here. You would get your AP code and you just need to type in your client code or AP code, generate the link and copy the link and share it with your friends or family members. And you will be getting 20% of the brokerage every month to your account. That's a wonderful scheme that we have here, all right? Okay, so let's begin today's session. So let me give you an outline of what we're going to see in today's session. We will quickly look at the history of candlestick, how candlestick started, why do we need a candlestick pattern, what is a candlestick pattern, and the different types of candlestick, okay? So candlestick charts were first developed by a Japanese rice trader to analyze the price of rice contracts, all right? And later on, it was introduced by Steve Neeson in his book, Japanese Candlestick Charting Techniques. It was introduced by Steve Neeson to the Western world, okay? And he changed the colors of the candles to green and red. So initially, the Japanese used it in white and black. When Steve Neeson came in, he changed the color to green, and red. So why do we need candlestick pattern? Well, candlestick is a pictorial representation of the price movement in the market, all right? So it's basically a communication tool for the market. Now, the market cannot communicate with you face to face, right? So these candlesticks help you to understand the language of the market. We can just compare this with the smileys that we use in social media, in WhatsApp and Facebook. We all use smileys, right? Now, sometimes when we don't want to use words, we use smileys, right? Say, for example, over here, you can see that the red candle is pretty angry, right? So even without words, we can understand that the red candle is upset. The green one seems to be happy. So basically, candlesticks is used as a market communication tool, all right? Like we all say, there is a story behind every house, right? If you look at the house from outside, you don't see anything. But just have a peek through the window and every house will give you a story, correct? In the same way, every candlestick tells you a story about the market, right? Now, candlestick also can be compared to the game of chess. So if you see here, you have the king, you have the queen, you have the knights, you have the pawns, right? All these pieces have a different role to play in the game. Likewise, all the candlesticks patterns have a different message to convey to the market, right? Okay, so now candlestick, apart from candlestick, there are different styles that you have in technical analysis. Let me give you a quick view of that. So this is a Market Watch page of Web Hunt platform. Now, here in the display, you can see there are various styles, right? You have the bar. If you click bar, you get the bar chart. If you click line, you get the line chart and various charts, right? But what is the importance of candlesticks? So let me tell you. For example, this is a line chart. You have the day underneath. You have days 1 to 5, and you have the price on this side. Now, these points that I have marked, these are the prices on day 1, day 2, day 3, day 4, and day 5. Now, if you connect these points, you get a line chart. See over here, right? But what is the drawback of line chart? Now, these points that you see, or these prices that you see on day 1 is 10 rupees, on day 2 is 15, day 3, say approximately 12, day 4 is approximately, say, 16 or 17, and day 5 is at 20, 21, right? These are prices. These prices are just closing prices, okay? So the drawback in line chart is you cannot see the opening price, you can't see the highest price or the lowest price. If you want to see all these price points, you will need a candlestick pattern, all right? Now, sometimes there can be issues in trading, right? Say, for example, you may incur a loss for 4 days out of 20 trading days because sometimes the fundamental overpowers the technical. When there's a sudden or unexpected news like the crude oil inventory recently we heard about, so we may have to incur loss at such times. But we have to be prepared to bear these losses mentally. So the point to remember is you need to make sure about your entry and exit levels, and your profit and loss ratio must be balanced. This way you will be able to protect your capital and have a successful trade, all right? So what is a candlestick pattern? Let's go in detail. So as I said, it is a method of reading the price chart, and in a candlestick you will see the opening price, the high price, the low, and the closing price, all right? See, you can see here 2 candles, the green candle and the red candle. Now you see here the green candle, or we call it the bulls, opens at the bottom. The opening price starts at the bottom and the closing price is at the top. It's just the opposite for the red candle or the bears. The opening price is at the top and the closing price is at the bottom. Now these sticks that you see, we call it wicks or shadows, right? These are the highest point and these are the lowest point. So both for green and red candle, the highs and the lows are at the same place. Okay. Now the red color and the green color is the body of the candle. So it shows the difference between the opening and the closing price. Okay. Okay. So now we all know that green is called bulls, right? And red, they're called the bears. But do you know why they are called bulls and bears? Well, these animals are used because of the mechanism they attack a person or a prey. So when you see a bear swipes down, it uses its hand to swipe down the prey, whereas the bulls uses its horn to push up its prey, right? To make it more clear for you, have a look at this picture. You see the bear is attacking the person and the attack is towards the bottom, it's going down. But the bull is attacking the person, but the attack is towards the top, it's going top. So if you understand this concept, it's going to be very easy for you to understand what do you mean by bulls and the bears. The bulls basically represent the buyers and the bears represent the sellers. So when you say a bull market, it means the market is going up. And when you say a bear market, it means the market is going down, right? So I'm just giving you visual representation so that you can understand the concept clearly, all right? Now, it's very important to understand three concepts or 3 points in reading a candlestick pattern. Now, we all know there are several kinds or types of candlesticks, right? But whatever the candlestick you see on a chart, there are 3 things that you need to remember. If you understand these 3, you will be able to read the chart. So the first thing is the body of the chart, body of the candle, okay? The second is the shadow of the candle. And the third point to remember is the body in comparison to the shadow, or the body relative to the shadow. Now, if you see here in the first candle, when the body is really big, okay, it shows a strong buying control, or the strong buyers, okay? And the shadow is quite small. So we can say the weak price rejection. There has been a price rejection, but the rejection is quite weak, okay? It's just the opposite over here. The body is small, which means the buying control is quite weak. And you can see that the wick is pretty big. This shows a strong price rejection. So whenever you see a long wick, you can understand that there has been a strong price rejection either by the buyers or by the sellers. Okay? All right. The next thing that you need to understand is the time frame. Okay? So let me show you once again the Market Watch page. You see here there are several time. Okay? These are time frames. You can choose 1 minute, 5 minutes, 10 minutes, 15, 1 day, 1 week, and so on. Right? These are time frames. So, for example, if you have chosen a time frame of, say, 1 month, okay? Now, since we are in the month of June, okay, let's say this opening price starts from 1st of June. Now, if you're on the 1st of June, your opening price would be 100, okay? And the end of the month, the 30th of June, your closing price would be 120. In between the month, the price can go down and price can go up to the highest, and then it closes on June 30th at 120. All right. So whether you choose a 1 hour time frame, so at 4 o'clock, this would be the price. By 5 o'clock, because it's 1 hour, this would be the closing price. So that's how the time frame works. Okay. Now you might be wondering what time frame to use. Well, it again depends on the trade that you take, whether you're taking an intraday, you're going for a long, it doesn't matter. Whatever time frame you're choosing, just remember the rule is if you feel confused about the time frame, for example, you choose a 15 minutes time frame and you're not able to understand the trend there, always move up the time frame, which means if 15 excuse me, if 15 minutes is confusing you, move up to 30 minutes and then you will have a clearer picture. Again, if 30 minutes is a confusion, move up to 1 hour. All right, just move up the time frame and you will have a clearer understanding of the candlestick patterns. Okay. All right. So let's move on to the types of candlesticks. We start with doji. Have a look here. So doji basically has a very small body, but it has a really long shadow or a wick. Okay. Now doji shows you the market is indecisive, meaning there are no winners here. So if you see the doji, the opening price starts at 100, for example. The closing price is at 102, which means there is hardly any difference. It's just a difference of rupees 2, right? So neither the buyers are winning nor the sellers are winning. So the market is quite indecisive in a doji pattern, right? So both have tried their best to push the prices up. So basically, doji shows a trend reversal. When you see a doji, you can see here, this is a doji, and you see there's a trend reversal. There is another doji, there's a trend reversal. There's a doji, there's a trend reversal, right? So basically, doji indicates a trend reversal. The next one is a dragonfly. This is a dragonfly doji, and this is a gravestone doji, right? Now, to remember the dragonfly pattern, you all know the dragonfly is a fly, like it looks like a helicopter, and it flies high. So because it flies high, just remember whenever you see a dragonfly doji, there is an uptrend. Just remember fly high. So you will remember the dragonfly doji indicates that there is going to be a bullish reversal, right? But when you see a gravestone doji, a gravestone, then by the name you can understand that it's a negative indication, right? So again, when it's negative, the market is going down. So these are some things that you can remember, right? Dragonfly flies high, so the market goes up. Gravestone is a negative name probably, so it goes down, okay? But also remember, the pattern before the trend is downtrend for a dragonfly. For a gravestone, the pattern before the trend is an uptrend, okay? Okay, so these things are pretty clear. Let's move on to the next one. This is a hammer. Why is it called a hammer? Because it looks like a hammer, right? So hammer is basically a bullish reversal pattern, which can be seen after a downtrend. You see, there is a downtrend and you see a hammer, right? It's a single candlestick pattern. The body of the hammer can either be red or green, okay? The color doesn't matter. What matters is where you see this pattern. If you see this pattern after a downtrend, you should know that this is a hammer, okay? Now, if you look at the body and the wick should be 2 times the size of the body, okay? That indicates that it's a hammer, all right? Usually there's no shadow. So if you see here like a textbook picture, you see there is no shadow, right? But sometimes you will find a shadow, a small shadow over here, you see? So that's acceptable. That's not a problem, right? So ideally there should be a gap down from the close of the previous candle to the open of the hammer candle, all right? And what does this show? What does hammer show? It shows rejection of lower prices. The sellers pushed it up all the way, okay? But the buyers or the bulls came right back and closed it. Where did they close it? They closed it over here, okay? So this trend is going to change over here. You can see there is a reversal pattern here, right? And there's a constant selling trend before the hammer. So before the hammer, there should be a constant selling trend. And after the hammer, you see a bullish reversal pattern, all right? So the hammer shows that the sellers have tried their best, but the buyers proved stronger at this point. So at this case, you see that the sellers are confident, but suddenly the buyers are proven to be strong, okay? Now the confirmation is the price. How do you confirm? Is the price trades above the high of the hammer candle. So this is the high, as we saw before. This is the low of the hammer, and this is the high. Now, where is the price trading? It should trade above the high of the hammer candle. That is a confirmation you get, okay? All right. Now have a look at this picture. Which candlestick is a hammer? I'm going to give you just a couple of seconds to identify the hammer here. So remember the points that I told you. You need to check the body, you need to check the wick, and the wick relative to the body. So what did I say? A hammer has a body, small body, but at the same time the wick should be 2 times the size of the body, correct? So if you see all these pictures, in all these pictures, the wick or the shadow is 2 times the size of the body. So when you see a real chart, a live chart, you may see a small body and a long wick. You may see a little bigger body and a long wick. All these 4 pictures are hammers. Okay, so don't get confused. Always check if the wick, if the size of the wick is 2 times bigger than the body of the candle. And also check the trend. Is it coming after a downtrend? Okay. Let's move on to inverted hammer. Inverted hammer is simply an upside down hammer. You can see it's an upside down hammer. It is a bullish single candle reversal pattern again. The real body can either be green or red, depending on your charting platforms, right? It can be green or red or black or white. Now again, the upper shadow is at least 2 times bigger than the body of the candle. That's what you need to remember, okay? Now usually again, there's no shadow below the body, as you can see it here, but in a real chart, you may find a small wick, a small shadow. So that's acceptable, that's okay, all right? Always remember, it should come after a downtrend, all right? And the confirmation of inverted hammer is when the price trades above the high of the inverted hammer candle. So where is the high of the inverted hammer? Have a look here. This is the inverted hammer and this is the low. This is the high. So the price must trade above the high of the inverted hammer. That is the confirmation you get. Okay. So likewise, as I said about hammer, make sure that the body and the wick are relatively compared. The wick should be 2 times the size of the body. So which candlestick is an inverted hammer here? All these candles are inverted hammer candles. Make sure you check the trend. It should come after a downtrend. And when you see an inverted hammer or a hammer, the trend moves to a bullish reversal. Okay. Okay. Let's move to the next pattern, which is called shooting star. Okay. Now, shooting star is a bearish reversal. It's the opposite of inverted hammer and hammer. Okay, with a single candle, and the body of the candle is either green or red, as I said before. Again, over here, the wick or the shadow must be 2 times bigger or longer than the body. Okay. Again, you can see that there is a small wick in the real chart, but over here there is no wick. So even if you don't have a wick, it's okay. If you find a small wick, it's fine. It's acceptable, right? What you need to understand is that the patterns that you see are on the real trading platforms may differ slightly from what you see otherwise. So it's important to practice and train your eyes to spot the difference. Okay. Now this basically shows rejection of higher prices. The prices went all the way on the top and it got rejected over here and closed over here, right? So the bulls pushed the price higher, but the bears pushed it back down and collapsed it near the lows. That's what you need to understand. So the shooting star is seen after an uptrend. It's seen after an uptrend. So usually you may see a gap up opening, okay, leading to the shooting star. Now the confirmation, how do you confirm? A confirmation of a shooting star trade is when the price trades below the body of this candle, right? Let me show you. This is the body of the candle. The price should trade below the body of the candle, right? So this is the confirmation you get. Okay. As mentioned again, you see the same patterns. You see the body is, the wick is 2 times bigger than the body, correct? All these patterns are shooting star. The 3 points that you need to remember, it should come after an uptrend. The wick should be 2 times bigger than the body. This is a shooting star. This is also a shooting star. These two are also shooting stars, right? So the body, the wick, and the trend. Make sure you check all these 3 before you identify, before you understand what the pattern is, okay? So this is a comparison between the shooting star and the inverted hammer. You see the shooting star, if it appears during an uptrend. You see both these look the same, but how do you identify it on the chart? Look at the trend. Where does it appear? That's important. Look at the trend. So this is the difference between shooting star and inverted hammer, right? You need to identify it with the trend. Now both shooting star and inverted hammer looks the same, right? And the color is also green or red. But how do you identify? You identify with the trend. The shooting star is seen after an uptrend. The inverted hammer is seen after a downtrend. Okay, please remember that. Okay, so I'm just going to say that again. Somebody has requested the difference between shooting star and inverted hammer. Can you see here on the chart, the trend is uptrend, right? This is a shooting star. An inverted hammer also looks the same, remember, right? But you need to follow the trend. If you find this candle, an inverted hammer kind of candle, after an uptrend, that is a shooting star, okay? But if you find the same kind of candle, an inverted hammer, after a downtrend, that is an inverted hammer. So the point is to note the trend. Where does it appear in the chart? After a downtrend, it's an inverted hammer. After an uptrend, it's a shooting star. So I hope it's clear for you now. Okay, let's move on to the next one. Hanging man. So hanging man, by the name itself, it suggests that it's a negative indication, right? Okay, so hanging man is basically a negative indication. So with the name, you can identify when it's negative, the trend is going down. It's a bearish reversal pattern. Now the body can either be green or red. The shadow of this candle appears again 2 times the size of the body, right? As I said for the previous patterns, usually there's no shadow above the body of the candle, but sometimes there could be a small candle. That's acceptable, all right? So how do you confirm the trade here? The price trades below the low of the candle, all right? When the price trades below the low of the candle, you can confirm it. Now, some others may wait for another candle below the low, so it depends. Some people may wait for another candle. So it depends. So it depends on the way you trade and what works best for you, all right? So which of these? So this is a hanging man. So you see, as I said, it can be either red or green. The point to note is, where does it appear? It appears after an uptrend, and you see a red hanging man here, and there's a downtrend. Again, you see a green hanging man here. Don't get confused that it's going to be a bullish trend. No, it's after an uptrend. If again you see a hanging man, the trend is going to reverse to bearish reversal. Okay, so the color doesn't matter. What matters is where it appears, meaning where the trend is. On what trend does it appear? Okay. So basically what you need to remember is that a candlestick reversal pattern just shows a higher probability of a trend change, possibly to the opposite direction, or sometimes it can go sideways also. So what do I mean by sideways? This is a downward trend, correct? And this is an upward trend, but sideways is this pattern. You see here, there's a small sideways trend and then it goes down, right? So it's not necessary that the trend will go immediately down after you see this pattern. It can go slightly sideways and then go down, okay? Sorry. So you see the difference here now, like we saw the difference between the previous difference. Hammer and hanging man look the same, correct? But again, as I told you, do not look at the color or the shape. Look at where it appears. It should, a hammer appears after a downtrend. A hanging man appears after an uptrend. Let me just rewind that for you. Look here. Uptrend, and you find a hanging man, and there's a bearish reversal, right? I want to see a hammer here again. A hammer, this is a hammer you see, but it comes after a downtrend and shows you a bullish reversal. So remember, a hammer comes after a downtrend, it shows a bullish reversal. A hanging man comes after an uptrend and it shows a bearish reversal. Okay, I hope it's clear for you. Again, as I told you, make sure to check the trend, check the body and the size of the body relative to the wick. So the wick should be 2 times the size of the body. So all these are hanging man, okay? Don't get confused saying that it's a small body, it's a big body, so it's not a hanging man. No, the body compared to the wick, that is what you need to see. The wick must be 2 times the size of the body, okay? So all these pictures are hanging man pictures. Okay, let's check out the engulfing pattern. This needs 2 candlesticks and it's pretty easy to spot, okay? You can see this is the first candle and this is the second candle. So what are the conditions, right? Have a look here. The first candle should be a bearish candle or a red candle. The sellers are in control. There should be a downtrend, okay? A downtrend followed by a bearish candle. The second candle should be bigger than the first candle, saying that the buyers are in control, okay? And you can see the price has pushed all the way up till here. So basically the bullish candle here or the green candle must completely cover the red candle or the bearish candle. We can also say that the green candle or the bullish candle eclipses the first candle. Okay, you know the meaning of eclipse. Eclipsing or covering or engulfing, whatever you want to say, it covers the first candle. Okay. Now, if you want to place a stop loss here, it can be placed below the low of the bullish candle. So which is the low? This is the low. This is the opening price. This is the closing over here, and this is the highest point. So if you're thinking of a stop loss, you can place it below the low. Now, about stop loss, we will deal in a separate session altogether, okay? Now let's have a look at it in the chart as well. You see there is a downtrend formation. Can you see a downtrend formation, a bearish formation, right? The market has gone down. And we can see that after several lows, there has been a low here, there's been a low here, and then it has come down, right? There's a bullish, huge bullish candle here covering the bearish candle. So this clearly shows that the bulls or the buyers are in charge. So as I told you initially, when you look at the body, if the body is really big, it shows that the bulls are in control. In this case, the green color candle is really big. It shows that the buyers are in control. Okay. Okay, then we move on to bearish engulfing pattern, which is just the opposite of the bullish engulfing pattern. It's similar to the bullish engulfing pattern. There are 2 candles here, right? But it's just the opposite. The first candle is bullish. The first candle is bullish here. The second candle is bearish. Just remember, in the bearish engulfing, the second candle will be bearish. In bullish engulfing, the second candle will be bullish. Okay. Now here the bears, so the sellers are in control. You see, it should be formed after an uptrend. There's a huge uptrend here, and there is a bull strong here, okay? But the bears have, or the sellers have become dominant. There are more sellers have entered the market here. So in short, compared to buyers in bearish engulfing, there are more sellers. And again, If you're talking about a stop loss here, you can place it above the high point of this bearish candle. All right. In detail, the stop loss session will be taken for you, so don't worry about that. Now, these engulfing patterns are quite useful to identify the market reversals. Okay. So if you look at it in the chart, it should come after an uptrend. Yes. Remember, you may be able to see other engulfing patterns. Now, this is a point that I need to emphasize here. Now, you may say, I see an engulfing pattern here. Yes, it is an engulfing pattern, right? But the point you need to remember is here you can see that there is a high, yes, and it's at a resistance level. A resistance level is over here. So this place, when the engulfing pattern appears at the resistance level, at the highest level, this is a very high probability trade. Okay, that's how you need to understand. So you may see different engulfing patterns in the chart, but look at the point, at the level at which it is spotted. Okay. All right. The next one is piercing pattern. We can also call it as piercing line pattern. Now, this is a pretty good pattern for the Indian stocks and also for stocks which have a gap up or gap down. So it's an important candlestick pattern. So basically, the first candle over here, what you need to understand, forms after a downtrend. Okay, and the body of the candle is usually a little big. Okay, because the market is quite bearish. Okay, and we over here, when we see this pattern, we still think that the bears are going to be dominant, right? The sellers are still pushing in the market over here. That's the indication when you see a big red candle. And you can see that there is a gap down. Can I show you here? Here. There is a gap down here. Can you see a gap down? Excuse me. So it's called a gap down opening, okay, here. And the second candle, which is a bullish candle, is formed next to the bearish candle. So here the buyers have confidently closed where? Can you see the closing? Where have they closed? They have closed above the midpoint of the bearish candle. That is the indication of a piercing pattern. If the second candle, that is the bullish candle, closes above the midpoint, or let's say the midpoint is 50% over here, this candle should close above 50% of the bearish candle. Then you can call it a piercing pattern. Okay? Now, if you see here, this is another chart which is in black and white. So depending on your trading platforms or your charting settings, you can have red and green or black and white. This is called a bullish piercing pattern because the bulls have taken charge here. They are confident, and we can see that the trend is reversing towards the top. Yes, it's an uptrend. That's why we call it a bullish piercing pattern. Okay. Now we come to the dark cloud cover. Now this pattern is just the opposite of the piercing pattern. The first candle is a bullish candle. You can see the price opens over here, and the buyers have pushed all the way up, as you can see, and it closes over here, right? This means, what does it mean? The sellers have come in and pushed the price all the way down. So in the dark cloud, what you can see is the pattern. The second bearish candle, which is this one, this is the second bearish candle. Where does it close? It closes below the 50% mark of the bullish candle. In the piercing pattern, the second candle closed above the 50% mark of the first candle. In the dark cloud pattern, the second candle closes below the 50% mark of the first candle. That is how you need to spot it. Okay. It might look similar to the engulfing pattern, but train your eyes to spot the difference. Right? So don't get confused with the engulfing pattern and the piercing or dark cloud pattern. The point to remember is, where does it close? In both piercing and dark cloud cover, the closing is above For example, let me just go back to this point. You see here, the closing, I'll show you the chart. The closing is above the 50% mark of the bearish candle in piercing pattern, right? And it's a bullish reversal. It's above the 50% mark. Likewise, in the in dark cloud cover, the closing is below the 50% mark. That is how you identify if it's an engulfing pattern or a dark cloud cover or piercing pattern. Okay, I hope it's clear for you. Now, basically, what does this show? It shows that the bears, the sellers, have gained control. So we can say that the market has rejected the gap up. There has been a gap up here. The market has rejected the gap up opening, and the market has not accepted it. And we can see that many are selling and exiting the market, creating a bearish trend reversal. Okay. Now, if you can spot a third bearish candle here, it's a good confirmation, but it's not necessary that you find a third candle. Okay. So there's another chart for you here. There's an uptrend, you see. This is the dark cloud pattern. And if you can see again, what is the point you need to remember? This is not an engulfing pattern. It's a dark cloud cover pattern because it closes below the midpoint of the bullish candle. 50%, this is a 50%, and just below that, it's closing. That's how you need to remember. Okay? So this is a comparison between piercing and dark cloud cover. Piercing pattern happens after a downtrend. You see there is a 50% mark here. The second candle closes above the 50%. In dark cloud, again, the second candle closes below the 50% of the first candle. Remember that. Next, we come to Harami. Okay? Harami is a two candle reversal pattern. Okay? It can be either bullish pattern or it can be bearish. Okay? Depending on where it is within the price action. Now, Harami is a very important candlestick pattern because this pattern can be seen all over. Whether you deal with stocks or say commodities or currency, you will be able to see this pattern. So pay attention and practice this pattern. Okay. Now remember, all these names are in Japanese, right? All these names are in Japanese. Now, what does Harami mean in Japanese? It basically means pregnant. The word Harami means pregnant. Now, if I need to connect it with the candles, what can we say? Pregnant means a small body inside a big body. Just remember that. A small body inside a big body. So the second body is quite small, and we can say that's inside the body of the big candle. Okay, that's how you spot a Harami. Okay. So a bearish Harami occurs at the market top. Bullish and bearish are quite similar in concept. Bullish and bearish are quite similar in concept, okay? The only thing to remember is where do you spot it, all right? A bearish Harami is spotted after an uptrend, okay? Now just remember this concept. Whenever you say a bearish reversal or a bullish reversal, it means the reversal which is on your right side, the pattern which forms at the right side, okay? So when I say this is bearish Harami, what's happening on the right side of the chart? It's going down, correct? So this is a bearish Harami because you see the body is small and it is contained within the bullish candle. So bearish Harami comes after an uptrend. Bearish Harami comes after an uptrend, and then you see a downtrend, okay? Now, if you see a bullish Harami, it's just the opposite of the above, but it forms at the bottom. It forms at the bottom, which means there should be a downtrend first. Show you a similar one. Yeah. There should be a downtrend, and then there should be the body, and then you go into the bullish Harami. Now, this what you see here is actually a Harami cross. It has the same concept of bullish and bearish Harami. The only difference is you see a doji instead of a body. You remember what's a doji? In a doji, you don't actually see the body. It looks like a cross or a plus sign, right? So all these Haramis have a similar concept, only you need to remember where the trend is. So I'm going to repeat this again. For bearish harami, you need to see an uptrend first, and then you see the downtrend. For bullish harami, you need to see a downtrend first, and then you see the reversal pattern. This is similar for harami cross. So this is a bullish harami cross. Why? Because the reversal is towards the top. It's an uptrend, correct? You see a cross here, and the market is moving upwards, right? So this is a bullish harami cross. The opposite of this would be bearish harami cross, right? Where the market will go down. You see a doji pattern which is engulfed inside the first candle. Okay? So the color variation that you may spot is a harami cross. So always make sure the prices are near the levels. Do not trade with your emotions. Learn to control your emotions, be it long candlesticks or short. It doesn't matter. You need to work with the levels. Okay? So I'm going to give you a simple rule to follow here. You buy at the support level. Okay? This could be termed as a support level at the bottom, and you sell at the resistance level. Okay? Now, support and resistance is a whole new concept, different concept, which will be dealt with in a completely different session. Okay? So what I want you to do is I want you to train your eyes to spot and identify the various patterns. Practice with the previous records. You can get it on internet, right? You can also get it in investing.com. So remember, these patterns are not 100% foolproof. For this, you need to have a balance between the risk and reward ratio. Never trade without placing a stop loss. That is important. You need to be disciplined in your trading and place your stop loss immediately once you make your entry. So before I close today, I would like to give you a small exercise. Okay? Here are 3 patterns. Okay? If you can identify these patterns, this is how you train your eyes. I have not written the names over here, so you can identify by yourself. Okay? I'm just going to give you a couple of seconds, and then I'll tell you what these patterns are. You can identify this pattern. I'm sure you can. This is a doji pattern. Yes. The second over here, you see what's happening here. This candle is engulfing this pattern, right? This pattern is engulfing this pattern, correct? So this is a bullish engulfing pattern because this is a bullish candle. And this is the opposite. This is a bearish engulfing because this is a bearish candle. Okay. Now the difference between harami and engulfing is, in harami, the entire body should be covered by the second candle. Okay. The complete body will be inside the candle. That's how you make a difference. This is another example over here. You see this, as I said, it closes above 50%, right? So this is a piercing pattern. What is this? It looks like an inverted hammer, correct? An inverted hammer because it's coming after a downtrend. This one is pretty simple. Remember the dragonfly, it flies high, going upwards. The gravestone going downwards. Okay? Now this is a harami. Can you see the difference between harami and the engulfing? The entire body is contained within this candle. And this is a hanging man because it comes after an uptrend. After hanging man, the market goes down. This is again the opposite of piercing pattern. 50% below this candle, it closes 50% below, right? So this is a dark cloud cover. You see a hammer. This is a hammer here. This is basically a shooting star. I'm sure you're guessing it right. And this is again a bullish harami. All right. So I hope this session has been beneficial to all of you. If you think you need to have more reading on this, please do go to our website, and also you can check into our knowledge center. Just click research here, click knowledge center, okay? And you have all the details of trading, technical analysis, fundamental analysis. If you click technical analysis, here you see you have candlestick patterns. Go into it and read it whenever you have time and practice these patterns, okay? Do join us tomorrow for the next session in Tamil, same time, 4 to 5 p.m. Thank you very much for joining.